and welcome to the Asset. I'm here today with Robert Crayfourd and Keith Watson, co-fund managers for CQS's Geiger Counter funds. So Keith and Robert, thanks for joining me today.
You're welcome. Hi.
And so maybe to kick things off, can you tell us a little bit about Geiger Counter Limited?
Yes, it's Rob and I manage 3 closed-end investment trusts, of which Geiger Counter is certainly one in vogue at the moment. It is dedicated towards the nuclear industry and an area that we think is most appropriate to invest in is the uranium mining sector. The raw uranium that goes into nuclear fuel is a small proportion of the overall cost of producing electricity from nuclear power, and as a result, the demand is very inelastic to changes in the price of the commodity, and so things can move quite materially and sustain high levels for a long period of time because of that price insensitivity of demand, and it's one of which therefore has very strong leverage to an improved environment. We invest globally, so for investors, particularly those in the UK, I think it's very helpful that they can gain access to a fund with a mandate that is unconstrained geographically. Typically, Rob and I look at projects which are going to be mines. We look at, I think we'll probably come on to the shape of the portfolio later on, but essentially it's all biased towards the actual uranium miners. It tends to be in tier 1 jurisdictions, but we do have some projects which are slightly higher cost than those tier 1 assets, which give you some more operational leverage on top. Clearly at the moment, the fund has just raised some money via the embedded rights. It is a little bit disappointing that it trades at such a discount, but therein is another opportunity to play what appears to be a fundamental sea change in sentiment, both at a government level and at, I think, consumer and public opinion level. It has, I think, as illustrated by COP28, come very much back to the fore as a central part of global energy policy. And no surprise, we think that would have been a very irrational and irresponsible decision to not bring it back into the fold, having basically been frozen out since 2011.
Absolutely. So yeah, we will definitely get into kind of, how you make those investment decisions and looking at your portfolio a little bit later. But first, I wanted to look at kind of the supply demand outlook for uranium. So there's definitely kind of global acceptance for nuclear has been growing. And some are saying that there might be a bit of a struggle for supply to keep up, especially given the amount of time that it takes for uranium projects to come online. So what's your outlook here in terms of that supply?
Would you like to answer that, Rob?
Yeah. I mean, I'm happy to start with that. I mean, look, we think it's a pretty simple story, really. I mean, we kind of try and break it down when we speak to investors that, you split the two sides of it, supply, demand, you kind of touched on it there. So the demand side, we have a very clear picture on. So you can see the number of reactors that have been built globally. They generally have long lives, so you have a very kind of stable form. Stable outlook there on demand from those existing reactors. The growth side is more driven by Asia. So you look to China, kind of adding 10 reactors per year. They are rapidly looking to increase their reactor fleet, and they continue to do so. So that's kind of your element of growth, and then the other element of sort of demand growth versus projections is extension of reactor fleet lives in the West, and we're seeing that feed through more and more given emissions targets globally kind of set post of COP. Well, all the recent COP meetings, but most recently COP28, and Keith touched on it there with 20 nations signing sort of tripling nuclear power output. So the key thing here is nuclear power is the only form of zero carbon baseload power. In a world where grids are kind of getting more destabilized as we get more renewable loading, that's increasingly important. So on the demand side, you have a kind of clear demand growth picture. So you kind of got that stable Western fleet that we touched on and growth out of Asia. And then on the supply side, so that's kind of where we really focus, and we think it's very interesting, is in mine supply side has been constrained given we're coming off the back of a sort of 10 plus year kind of bear market in the mining sector, and as a result, there's been very little investment into new supply. Lack of investment into if anything, actually, we've had like major producers curtailing production from their largest projects, which we're starting to see feedback through, in brownfield restarts, expansions. But we've got a clear picture on which those are. So you kind of got Cameco bringing one of their large mines back on, and then Paladin with a mine restart in Namibia. But beyond that, there's very little new growth other than some large projects like NextGen, which do have the largest sort of most material project. And then beyond that, things start to get a bit more long dated and certainly smaller. And so basically we have growing demand. We know what additional supply can come through, and ultimately it's kind of limited. So this points to a very clear kind of tightening market. And as Keith touched on earlier, there's very little sort of price, sort of demand elasticity to price, given it's such a small component of the overall cost. So that does mean we have a tightening outlook in the general market. And then as you move forward, prices can be sort of very volatile into that, so can increase materially. And then we look towards the back end of the decade, and SMRs are increasingly becoming a factor that we're starting to build into assumptions. So part of these emissions targets set by most major nations do include an aspect of SMRs being small modular reactors, and they're a major component towards trying to meet emissions targets. And this is an incremental layer of demand that can tighten that balance further.
Yeah, absolutely. I mean, what are some of the kind of external forces, or are there kind of geopolitical or other type of or other forces that kind of can impact what's happening in the uranium space?
Can I answer that one, Rob?
Yeah.
There are quite a number. I'd say if you look at the sector as an observation, you'll note that it's highly concentrated, and that brings with it or raises two key points. One, it's quite possible that we could have a situation where one of the mines is interrupted, such as occurred in 2007 with the flood at Cigar, which is owned by Cameco. That can have a material impact. That mine alone is 18 to 20 million pounds of production at full capacity. It's currently the largest single mine in the world. Another factor that clearly comes out of this is that geopolitics plays a large part in this. In light of the energy crisis, it's certainly energy security has risen to one of the major priorities that governments need to address, and security of energy supply is involved very much in the nuclear sector, with Kazakhstan producing some 45% of uranium units from the country, and with Russia responsible for an equivalent amount of enrichment in the supply chain. Clearly, that is something which will benefit those miners which are exposed to this, to help reduce and diversify sources of supply for utilities. Another factor is, I think, say the inventory cycle. Last year was the first in over a decade when utilities actually acquired more uranium than they consume on an annual basis. And as a result of winding down inventories over the last few years, it's difficult to not imagine that they're going to have to keep purchasing at higher rates than they have done historically. And where are they going to source that is one of the key factors. But for certain, I'd say that the two biggest factors are really a result of the fact that concentration risk is high. That could be geological, and it can also clearly take into account some of the sanctions that have been imposed on the likes of Russia, and by association Kazakhstan risks. And that is something which I think utilities are increasingly aware of in their buying cycles. And note that it's very difficult to get hold of pounds at the moment. And most of the main producers, whether that's Kazakhstan via its state-owned enterprise Kazatomprom, or even Cameco, have largely sold forward their expected production over the next 5 years. So we're going to have to find those pounds from somewhere.
I'll add a little bit more just on the sort of geopolitics, because we had that kind of supply-demand balance we were talking about, but it's really been exacerbated more recently. So we've had the US ban on Russian material, which would kind of phase in over a period of time. But more recently we've seen the Russian suppliers then calling for a waiver on those, or they would be forced to restrict those supplies. So Russia's been a major supplier of nuclear material. So whilst only about 6% of global direct uranium mined, so U3O8 production, they're about sort of 30-40% of global enrichment. So that's far more meaningful. And actually, when you look at the JVs that you have within Kazakhstan, then that adds about sort of 6-7% of global production is then sort of Russian controlled as well. And a large proportion of Kazakh material headed to Russia through their enrichers. So, the geopolitical situation we have there also, well, basically it's ended up in a situation where Asia and primarily China has locked up secure supply, and the West has found itself fairly short. So we've now had this kind of US import ban put in place, which does ratchet in over a phase of time, but it's the retaliatory measures that are anticipated from Russia in response to that could then tighten up that Western market further. And that's kind of what Keith was talking to within utilities, are now more focused on trying to lock up supply. So that's not the only issues we've had. We've also had coups in the likes of Niger, which has led to kind of a spat between the Niger, the new government in self-placed government in Niger, basically fell out with the French, so basically choked out the French military, and as a result aren't supplying uranium into French utilities. So that was a major supplier into Europe. So again, that has kind of further tightened up that kind of Western supply metric. And then there's also been some operational issue. Some issues in Kazakhstan. So Kazatomprom kind of reduced down its future production growth guidance, and that's following acid shortage within the country. And there's a debate there. That looks like that production growth downgrade could extend beyond, as acid plant introduction there is likely getting pushed out on a timing basis. So there's a number of geopolitical things and operational issues that have further exacerbated that looming shortage that we were talking about earlier.
Yeah, absolutely. And I think we can talk a little bit more about that later. But I wanted to talk, change topics a little bit to look more now at the investment side of things. So, what sort of investment opportunities are you finding in this space at the moment? And what sort of criteria do you use to kind of assess what makes a good opportunity for the Geiger Fund?
Rob's a geologist and has looked at a lot of the projects very closely from that side of things. My background has typically been in the processing side of things, but when we've looked around this sector, and both of us have covered it for a number of years, the one region which looks like it's going to be sustained as the most important globally for Western production is going to be the Athabasca Basin in Canada. And one of the better projects that we see there is NextGen's Arrow project, or Rook 1. It's one of the highest grade deposits. It's at the lowest end of the cost curve. I think it will produce below $6 a pound, and it's scalable. I think crucially, it's also the most advanced around the world in terms of its permitting. It has its First Nations in place. It's now really just waiting for that to translate through to the final federal permit, which will give it the ability to commence construction ultimately. But by virtue of being one of the largest scale projects and lowest cost, we think it has strategic value in being able to supply into an undersupplied market and influence quite heavily the uranium price itself. It possibly doesn't need to hedge as much as people think. Certainly it's just acquired some uranium on market in a very illiquid market. But for that reason, we think it's very strategic. At $75 a pound, it's probably not even trading at NAV at the moment. And conversely, and I think this is quite useful in terms of trying to illustrate the style of investment that Rob and I have, we don't feel the need to chase just the most liquid sector assets, which would typically be Cameco, which trades on something closer to 2 times NAV and is sold forward at largely lower priced contracts. We would much rather go for those projects which have operational leverage and strategic value yet to be reflected. As it happens, on that side of the Athabasca Basin, it looks like NextGen is going to be one of the centres of gravity for a few deposits in that region. It has Fission, which is another high-grade deposit to the south, and it's got another smaller projects that are sort of in joint venture with the likes of Cameco and Orano, formerly Areva, which could share some centralised plant that will no doubt be controlled by NextGen, who will construct it. However, we do also have some exposure to another glaring side of the market, which is the lack of domestic production in the US. It's typically higher cost of production. You know, most of them will print something around $40 a pound. That's probably optimistic. It will be higher than that. But they will also probably benefit from US government policy, which is trying to encourage some domestic production and indeed build up a strategic uranium reserve of fuel to see them through potentially difficult times. And again, these assets are on very low valuations, certainly in comparison to the more liquid side of things. And I think it's worth reminding investors that as a closed-end trust, one of the aspects that lends itself to that structure is that we can invest for the long term in less liquid assets where we see better value. That's something that we notice across our other investment trusts that Rob and I manage. But we also have a few projects that are perhaps higher cost again. Ultimately, they will need to be incentivized. That might be at something near a $75, $80 a pound price that represents, in the tail of the portfolio, maybe up to 10% of assets. It's probably a little bit less. And, you know, they give you operational leverage over and above what is already a very leveraged sector. So I think that is the key aspect that we would like to get across to investors, along with the fact that, again, to reiterate, the demand sensitivity to price is very low, and the uranium price can stay high for a long period of time, and we don't think investors should be put off thinking they've missed it. The valuations on NextGen, which is clearly a globally strategic asset, maybe to another large uranium miner, maybe to another energy producer in the oil sector, who knows, is not to be understated. And as a consolidator on that side of the Athabasca Basin, you know, that we think that has some further optionality to it. And then we've given a flavour for some of the other sort of areas of deficit, certainly in terms of the US shortage, given that nuclear power represents some 19% of its electricity production. It's clearly a very strategic industry for them.
Yeah, I mean, I'll add a bit to that. So just, you know, it's that kind of looming Western shortage that leaves us focused on those kind of more tier one assets and kind of friendly nations towards the West. That's where we see the best opportunity, because we expect that contracting cycle going forward to be positive, because these utilities need to lock up incremental supply. So within that, we're focused on names that aren't heavily contracted, and as a result, you can kind of see where by our weighting, we're kind of relatively heavily underweight Cameco, but we're overweight some of these developers, and you can see, you know, the likes of NextGen. So we're a bit more comfortable in taking that kind of permitting risk. So, you know, this kind of looming shortage in the West means permitting is likely to be more supported politically. You know, you're certainly seeing kind of a bit more of a shift there in the US, a bit more in that direction. So that slightly de-risks that on the, you know, the pre-production stage project. So we're a bit more comfortable to take a larger weighting in that. Definitely a bit more of that Western geographical focus, as we kind of touched on. But really, it's about the names that, because we're constructive on where the commodity price is heading over the near term and medium term, we want to be in those names that are going to be best positioned to maximize and actually receive the returns from those. And you know, you can see that we have names like sort of UR Energy with its US production, and you know, it's a relatively small producer, but it has the ability to ramp up production, but is best placed, you know, or one of the best placed, we believe, to maximize returns into a stronger pricing environment.
Yeah, absolutely. You know, with this kind of really strong performance in the uranium sector right now, are you seeing more investors, more kind of interest coming into this space?
Yeah, I'm happy to say that. We definitely had more interest. Yeah, I think for the broader market, I think there's been an issue. A number of fund managers we've spoken to, there isn't much kind of liquidity or names and options within the underlying sector, and that's where owning a basket like this fund, we think, offers a good degree of diversification. I think actually that's also quite bullish for the sector. We generally like commodities and sectors where it's hard to find good names, because it means there isn't a huge amount of new incremental supply coming through. But yeah, we think there's a strong opportunity coming through on the back of it, and so from an interest perspective, so when uranium was kind of pushed up and got to the sort of 106 level, then clearly there was a lot of retail flow coming through, and a bit more speculative flows into that. When uranium pulled back off that peak and we're kind of sat in the kind of mid 90s now, then that has waned slightly. Actually, I think that's quite healthy. In some ways, it was kind of getting a bit hot, and it's more consolidated, and actually that sets it up in a better place, given improving fundamentals going forward.
Sounds good. So to wrap it up, I thought we could kind of look at your stance on the overall future energy mix. So, as we continue to move away from fossil fuels, there seems to be kind of a very strong kind of focus right now on the battery space. But obviously, there is a strong mix of kind of what will entail kind of that future energy. So, as where do you see nuclear's role overall in this space?
I think the best highlight is actually what's taken place at COP28, when we had 25 signatories say that nuclear is the only form of zero carbon baseload power. And that doesn't mean it's the fundamental answer. We'd love to get onto things like fusion at some stage, just for the benefit of humanity, but we have to be realistic about how long and how much that will cost to become commercial. But this fits alongside some aspects of the more variable renewables. I think it fits very well in that. I'd say if we were taking the holistic view, the best thing that most governments could do is actually switch from coal to gas, and that instantly removes, I don't know how many hundreds of millions of vehicles off the road equivalent of carbon emissions. If you just look at carbon emissions as the benchmark here, which we would look beyond as well. The one thing that would be helpful to enabling the more variable renewable power is batteries, as you mentioned, something that we like, but it has to be cost effective in its own right. We don't think that, lithium is necessarily the answer for large scale storage. We need quite a lot of it. There probably is a lot of it, but it's perhaps some other type of technology, vanadium or some other form of redox battery is something that we look at, but we're not trying to be technological experts here, though we'd be happy to throw in our hand at trying to assess those. It may be partly, hydrogen fuel cells, which will play a role in that, which might lend itself to things like platinum as a catalyst in that. We'll look at those type of aspects, not necessarily in this fund, but generally I'd say that the most helpful thing that governments could do is, one, not shut down reactors prematurely. We've done that now. We've had a bit of a brief contracting period as utilities have gained confidence that foundation that they have isn't going to be shut down and in costly fashion. The other thing is to switch coal to gas, and then it's to try and, alongside using more gas, try and build up some battery technology that would be quite helpful to enabling the more variable power. And I think it's quite telling that we're now seeing some of the economics questioned on a number of these sort of special purpose renewable power ventures, not just because interest rates are going up, but because I think there are moves afoot to charge variable pricing on the time of day that, for example, solar is available at midday, and that is going to start to pressure some of the growth and rollout of that type of project potentially. Or we see changes in working practices of the big industrial users so that they use shift patterns that optimize the availability of cheap power, either when the wind's blowing, which is probably more difficult to predict than when the sun shines at midday, but that type of more holistic approach is something there, but there's just no doubt that we've had, thankfully, a rational move to keep reactors running as long as they're able to, and I think not only that, but to actually redeploy well understood, improved technology in generation 3 and perhaps 4, and maybe even small modular reactors that could reduce the capital cost hurdle up front to see some actual net capacity growth as targeted by COP28 to triple overall installed generating capacity from this segment of the market.
Yeah, I mean, I'll just add, I mean, small modular reactors, I think, are the key, a potential key driver here, because I mean, the main pushback on nuclear power as being the solution to sort of near-term issues is the long build time for reactors. And so not such an issue in China, where they build them in a fraction of the time as we do in the West, but so probably more of a Western issue. But SMRs will be a far quicker build time. And lower capex, sort of slightly higher opex, but far easier and kind of quicker to turn around. You know, we don't have the final design, so it's definitely more back end of this decade and kind of moving through. So, yeah, within that balance, I mean, more renewable loading is just creating more grid instability, and you kind of touched on it with grid storage. You know, that lithium doesn't necessarily answer that on a near term, and then yeah, it's how do they ultimately balance that? You know, clearly, nuclear is base load, and it's actually the only one form of power that could actually replace all other forms of power, and we could run the whole world on nuclear if yeah, which you couldn't on other sources, or certainly not on a zero carbon baseload power, because the issue is as you get higher loadings, then you have a higher renewable loadings, as you have a higher requirement for grid storage, and you kind of get to that point where it becomes exponential, and ultimately you could never go to 100% renewables on the basis of that, because you'd have to have an effective infinite you know, infinite source of power storage. And you know, we have seen some issues, you know, like solar across Texas, where hailstorms have taken out hundreds of acres, or you know, wind has issues where you get, you know, extended periods of low wind that can also lead to excessive amounts of storage. So yeah, it's going to be a patchwork of a number of solutions, but we think SMRs are key in that, and you know, it's encouraging for us that governments have clearly recognised that, and it's being put as a fairly central pillar within you know, emissions target policy from major governments globally, especially coming out of those COP meetings.
Absolutely, and I think that kind of governmental and you know, community-based you know, recognition of nuclear is definitely growing, and will continue to grow as you know, the industry requires. So those were all the questions that I had for you both today. Robert, Keith, I want to thank you for joining me here today at the Assay.
Pleasure. Thank you for having us.